All right. So recording is back on. I want to talk about these 6 scenarios that you just went through in this exercise, right? So the first scenario was you changed the profit, and when you increase the profit for A and B, what happened to the values? What happened to the multiples? So what did you observe? When you changed the profit, what changed? Yep.
The value increased instead of like the proportion of profit increase.
Okay, but did the multiples change? So why do you think that's the case?
Because given like a certain profile of ROIC and earnings, it's a multiple of earnings, so they're expecting to
Okay, so he said that given the profile of future growth and earnings, growth and spread, that if that doesn't change, the business model long term doesn't change, then the value is not going to change long term. So the multiple is not going to change. But if you make more cash, you can just become more absolutely valuable. So that's the idea of bigger. Just one way to become more valuable is just make more cash, right? But you're not better. It doesn't change what people pay for the cash. Okay, the future that they're going to pay is the other drivers, the key value drivers, the growth, the return, the WACC, the growth and spread. So the point that you're starting to see here is multiples, which we're eventually going to talk about in this class, are expressions of growth and spread. That's all they are. Future growth, future spread. Okay? But value is basically just pure cash. Okay, so bigger, more cash, more profit, more value, but not multiples. The next 4 things that you changed affected the spread, affected the multiples. Okay? And those are just 4 very important scenarios to understand. So the first scenario is what happens when you crank up the growth at company A but you don't change the spread? What happens to the value? What happens to the multiple, and why? Yeah. Why?
There's usually no growth or no value being paid because the RIC subtracted by the WACC is essentially zero spread.
Yeah, and at zero spread, you have, I joke about this, but like you have 0 NPV, and if I just do more 0 NPV, I still get 0 NPV, okay? And so I like to call this the treadmill, right? You're on the treadmill, you're working hard, you're running really fast, but you don't really go anywhere, and you eventually get tired, all right? Well, that's the treadmill. So I'm not just gonna pay for growth that's not very valuable. So remember that, okay? That's not good growth. The good growth is the next scenario. What happens when B cranks up the growth? What happens when B starts growing faster? What happens to the value? What happens to the multiple? And why? Does the value go up? Does the multiple get higher? So why? Why is B going up and A not? What's different? Yeah.
Not in the spread.
Yeah.
It's an attractive industry or attractive company.
This is what investors are looking for. I want growth at a reasonable return. And if I can get the 2 together, more of that becomes exponentially more valuable. This is where real value creation comes into play. It's basically just saying a bunch of positive NPVs, a lot of high IRRs. That growth is very profitable, very attractive growth. That's scenario number 2. Okay, so I got growth at no spread, companies in the treadmill, growth at a high spread. Those are the real attractive value creating companies. Scenario number 3, everybody matures. No matter who you are, you're going to eventually mature. Okay, or you deal with law of large number effects. Right? So if I'm a $20 billion company and I grow at 10%, that's $2 billion in revenue. If I'm a $200 billion company and I grow at 10%, that's $20 billion in revenue. It gets harder as you get bigger to grow the same percentages. That's called law of large numbers. So that's the point. When I deal with law of large numbers, company growth rates start to slow, or I just mature, growth rate starts to slow. What happens when I have a high rate of return, but then slowing sales? What happens to the value? What happens to the multiple? So high return, but 8% becomes 3%. What's going to happen to the value? What's going to happen to the multiple? Yeah.
It's probably gonna decrease,
Why?
because now you're not like, as well as spread's still positive, it's not going anywhere.
Yeah, so this is that expectation cornerstone at work. I price you as if. I price you as if you make 20%, and I'm going to CAGR that at 8% a year. Okay? CAGR that growth. But now I realize I was too optimistic. You make 20%, but you're now going to grow at 3% a year. Well, it's going to be worth less, right? So the value is going to be worth less, and the multiple is going to come down. Okay? It also means that I take two real-world companies, Google, which is expected to grow in the mid-teens, Apple, which is expected to grow mid-single digits. They're going to have different multiples. And it doesn't mean that Google, who has the higher growth rate, is going to have a higher multiple, is better than Apple. It just means they're different. And Google, as they get bigger, is going to start slowing its growth down, and eventually their multiples are going to look more like Apple's. Okay? And so that's the point. A higher multiple is not necessarily better. It's really just different. You're at a different growth spread trajectory than a company with a lower multiple. Right? And as you mature, your multiples will come down. That's just something we should always remember. That's scenario number 3. So what was scenario number 4? What was the 4th scenario? Or the 5th one in this case. What was the next one? It's growth at a negative spread. When you have a negative spread, what happens when you increase the growth? $8 ROIC, 10% WACC. What happens when I start cranking up that G? Yep.
The value in the multiple decreases.
Exactly. Because you're just, what?
It's kind of like the negative NPV scenario.
Yeah, you're just doing a lot more bad things. And you're just destroying more value at a faster rate. Okay? That's a scenario you really don't want to be in. Those are the value destructive scenarios. Right? And so the question is, what do I do if I'm in that circumstance? What if I have this company that just has this business that's just awful and is losing a lot of money? What do I do with the growth?
Go in the opposite direction.
Yeah. Did you see as you slowed the growth down or even went to negative growth how the value went up? Because I'm either destroying less value, which is incrementally creating value, or I basically stop the really bad destruction growth. So both of those situations are what you look for when you really can't turn that spread positive. Okay, because those are the most destructive value parts of a business. Yes, sir. Sorry, hand question. Okay, so understanding those 4 scenarios is really important. Here is Apple's stock price. Talking about Apple. For the last 30 days. And I bet you can guess Wednesday of last week why the stock price started to plummet, because that's when the news from China came out that China was going to limit the ability for Apple iPhones to be used to people in their ministries. Right? Which of those 4 scenarios is playing out right now with Apple? Is this the treadmill? Is this the high expectation return? Which of these is it? It's what? What's happening to growth? Decreasing growth, but Apple still makes a high rate of return. That's what you're seeing in front of you. That's what the market's doing. They're repricing Apple because Apple's iPhone sales in China were expected to be a lot higher. People are now nervous about as many iPhones being sold in China at that high price, and so therefore they are worth less. Okay, so that's the cornerstone at work in the real world. Now there's data around this that we're trying to quantify, but just conceptually, we should understand the direction of this. That's why I said Apple's an interesting trading opportunity, because tomorrow when they release the iPhone, there's an expectation for iPhone sales, iPhone 15 sales, which are very important to their bottom line. And if we start to learn over the next week that they're going to sell more than expected, that's going to be which of those 4 scenarios. If we realize a week from today that Apple sells more iPhones than expected, which of those 4 scenarios will start playing out? Yes? At a negative spread or a positive spread? Increasing growth at a very high spread, that's going to actually see Apple start to go up. If they see fewer iPhone sales than expected, because people, for whatever reason, are holding on to them longer or more competition, then you'll see this scenario play out further that's on the screen right now, in their stock price. Okay, but I'm just telling you, not only can this help you start thinking about your Bloomberg Trading Challenge, but this is just how things conceptually will start to play out in the real world. And the more you start to kind of think of these scenarios into the context of what you see happening, you'll start to understand why stocks do what they do. Okay, now there is a sixth scenario. What happens when the cost of capital goes down? That was the final scenario in this little exercise. What happens when the WACC just goes down? What happens to values? What happens to multiples? And why? What happens to the values? What happens to the multiples? Yeah.
They should both go up.
Why?
It's essentially, for example, it could be now a positive spread. If the ROIC was 10%, the WACC goes down, your positive spread, so it's increasing the value.
So I agree with you that a higher spread should increase the value, but that's not what's primarily at work here. There's something more fundamental. If the WACCs go down, if the cost of capital goes down, if the discount rate goes down, what else is at work? Watch this. Let's say, I'm going to reset this. Company B, Company A, both increase their spread to by 2 points. So 12% ROIC, 12% WACC. 22% ROIC, 12% WACC. I'm going to make this 24%, and I'm going to make this 14%. And in both cases, the values of multiples are still lower. Even if the spread improves, the multiples are lower. Why? You guys are finance majors? Yes.
Because the denominator you're discounting the WACC minus the growth, because the growth stay the same and the WACC increases in a certain period of time.
What happens in a present value when you increase the R? What happens in a present value when you increase that cost of capital? What happens to cash flow? It's worth less. That's what's happening here. So this is the part that's often overlooked. When the discount rate changes, that affects values, right? In and of itself, regardless of spread. Because if we have higher cost of capital, we're discounting cash flows at a higher rate, they're worth less. If we have a lower cost of capital, then we're discounting those cash flows at a lower rate, they're worth more. 2 years ago, the yield on the 10-year Treasury was 1.5%. Today, the yield on the 10-year Treasury is over 4%, approaching 4.5%. Okay, so that means risk-free rates have gone way up, not just the U.S. but around the world. All things being equal, if I'm discounting those earnings and cash flows at much higher rates, those earnings and cash flows aren't worth that much. That's what was happening early part of this year. That's why the stock market was so choppy, because hurdle rates were higher, cash flows didn't change, values go down. Now we went into an inflationary environment where companies actually started growing their revenue and cash flows faster. That's kind of offsetting the higher hurdle rates. But what now people are starting to worry about is that inflation is coming down and cost of capital stays high. That could put pressure on stocks, right, in and of itself. That's why what happens with interest rates is very important over the next 6 months. If we believe that we've tamed inflation and long-term interest rates start coming down, that could be a boon to the stock prices, right? Because basically we're just discounting all those cash flows at a lower rate again, multiples will start going up, right? If it doesn't, it could be really bad and ugly for the stock prices, because if hurdle rates stay high and cash flow growth starts to slow, that could put pressure on stock prices. So this is the sixth and often overlooked driver of value creation. But these 6 scenarios, right, generating more cash, just being bigger, the treadmill, growth at zero spread, the value creation, growth at positive spread, okay, the maturing company, okay, growth at slowing spread, or sorry, high spread, slowing growth. And then we have the just pure value destruction, growth at negative spread, and then what is the overall level of risk that's being associated. Changing that cost of capital also affects the value. Understand those 6 things, and you'll have a pretty good idea of why things are happening, because we're going to get lost in the detail of this stuff later, but high level, key, value drivers. That's what all this is based upon. Make sense? All right. I'll see everybody a week from today. That's our next live lecture, Bloomberg Lab on Wednesday. Work on homework 3, work on your trading challenge, and most importantly, finish your certification by Friday. Have a good week.